Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for the Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. This is the Mortgage Voice, and welcome to our weekly show that we bring to you each and every week. I have been doing it for a long, long time, trying to get you to understand what's happening in the mortgage market, what's happening in prices, what's happening in the real estate market, how you might take advantage of some of this ongoing information that we provide to you. The bell has rung, by the way. I don't know if you heard it this week, but it went really loud, and it was really a gong-type sound. 8%. 30-year fixed-rate mortgages. That's right. We have breached the 8% mark. Now, I had said earlier in, I guess a couple months ago, that we would probably see 8% by the end of the year. But 8% today, middle of October, middle to late October, that's a big number, 8%. It really drives people from the market. And most of it is because they just can't see a path to be able to afford the monthly payment at 8%. I understand, especially if you remember the days of 3% or 4% or 5% or 6%. All of these things taking place over the last 18 months. The rise is meteoric, and we don't see really any slowdown between now and the end of the year. Now, there are some who predict that we may have a slight remittance of that early next year for whatever reason. But we've had a confluence of events over the last week to 10 days. We talked a bit about it last week on the show. Never directly talked about it, but war is never a good thing for financial markets. Absolutely not. Now, there is flight to safety, sure. People wanting to jump into treasuries, but if you've noticed, and this is the conundrum we're also under, that treasuries, U.S. treasuries, are actually yielding more now than they had been. Now, why is that? Why don't we see that flight to safety, either foreign money or domestic money, going into treasuries, lowering the actual yield and raising the price of the actual cost of the bond? Interesting, but not necessarily good news for anybody out there. Obviously, if we're going to look at the 2-year at 5.21% and the 10-year at 4.9%, both of these yielding excellent returns, we're looking to, why is that? Why aren't people wanting to buy U.S. debt when we have two wars going on in the world? The one most recent, Biden's trip, a bunch of other ancillary events happening in that cavalcade of just misery over there. It's just awful. Never stops. Hasn't stopped in my lifetime. I've been there. It just doesn't, it's one of those situations whereby you can't see any way that this is going to end. So this is an ongoing, continuous thing that we're wrapped up in it. And usually what happens in the financial markets is people invest in bonds, drives the yields down, and yields going down obviously would drive the mortgage rates down. It just isn't happening that way. We see the exact opposite, i.e. the bell has been rung, 8% mortgages, 8% 30-year fixed. Conversely, the 15-year is not as high. Obviously, it's a lot less, 7.25% for the 15-year fix. That's a big deal. That's 3/4 of a point based on a 30, based on a 15. Now, obviously, in the 15, you got to pay more because 15-year principal you get to much quicker, and you also have to pay more on your monthly payment as the mortgage bill comes due. But that's still a very good price, 7.25% in this market, 7.4% for the FHA. But you also have to add in on the 7.4%. Now, the one FHA, everybody knows that's a good deal if you don't have the down payment, because they'll pay, they'll loan up to 96.5% of the loan value. You have to bring in 3.5%. And with the DPA programs out there in the marketplace, and there are some of them, we have a couple of good guests coming on today to talk about products in the marketplace and how they might best suit this particular market, especially an FHA product. But with the FHA product comes mortgage insurance premium, and that doesn't go away. That's a killer. That really adds, a good point and a quarter on a yearly basis to the monthly that you're going to have to pay, and so it really makes FHA not as attractive. It's almost more than the 8% for the 30-year fixed rate. The jumbo products is at 8.06%. That's more than the 30-year fix. And, of course, the 7-1 ARM is at 7.25%. I said the 2 years at 5.21, great return on the 2 year, and the 10 years at 4.90. That too is at great returns. So if you want to see and hear this show, I jumped into that really early on just because it's important to understand the significance of the event. World events aside, if you're looking for a house and you're looking for long-term security to try to get into a market which is ascending continually over the past, 5, 6 years, it's going to be harder now because the rates are higher and it's going to cost you more. So if you do want to see us, Malibu Funding, Jeff Barton, the Mortgage Voice, is a good place to go on YouTube, and you can see that. Malibu Funding, by the way, has been sold. Malibu Funding was purchased by a gentleman named Chris Pyro, who owns Searchlight Lending. Wish him all the best to that enterprise. Yours truly still has an address and a coat hook at the Malibu Funding, so if you do want to reach me, that's fine. 79687 is my NMLS number, and the company, of course, is 79620. Anybody who's looking for good and honest people to help you through the mortgage maze, you can go to malibufunding.net, and on that website you will see a number of different people who have their profiles and their NMLS numbers and ways to get in contact with them. Also, on this show, themortgagevoice.com, we also have a website. If you go there, themortgagevoice.com, you can see me and a bunch of other guests who have been on the show, contact them directly. It's a great way to stay in touch with me and the show, and it's a great way to get a hold of the people that you've heard on the show. Obviously, they're the ones you want to talk to because they're either talking solutions or they're talking programs or they're talking some aspect of the loan or mortgage business that might be able to assist you in your own deliberations about what you want to do. The economy. Let's get right to it quickly while we got about 3 minutes left in this particular segment. The economy is doing way better than most people thought. Now, you would say, okay, you got 2 wars, very uncertain times. The treasuries keep rising in terms of their yield, and the price keeps dropping. And that's usually inverse proportional, meaning that nobody wants to buy U.S. debt. So why is the U.S. economy doing so well? Well, apparently the consumer is still spending. That's the key here. If the consumer is still spending, and you know what, I got into a stupid, and I don't know why I do this. On Facebook, everybody who's my age, which is the boomer generation, they get on Facebook and really just shout out what they think. And it always comes down to one side versus another side. There's no nuance, no. So I've taken a snarky approach to Facebook for years. So I got into a back and forth with someone about what's happening, not only with the U.S. economy, but also with the Chinese economy, right? And why there are differences and why we're interdependent on one another as opposed to it's us versus them. And so, of course, this person being not really that well-versed in the nuances said, okay, this is terrible. China's doomed. They're lying about all their financials. You can't trust them. Pull your money out. Now, I've seen many different scenarios that the financial people, either on CNBC or Bloomberg or MSNBC, talk about these exact points and to say that, hey, I'm not going to go there. But for most part, most people realize that what China does is supplies America with a lot of products that they don't make here at home. And they do it cheaper, therefore it's cheaper to buy. And it's been going on for a generation, if not more. The Walmartization of the world happened a long time ago. And it all was due to this ability of the Chinese to make products cheaply and sell them to American companies. Now, American companies, in reverse, have always thought that the IP, the intellectual property that they have, was their saving grace in the way by which they can compete, by which they have a boutique approach towards what we sell to China. China has a macro approach. We sell you everything because we make everything. The U.S. will sell you certain things because we do it better than anybody, and it sort of balances out. Certainly, the trade of balance in the trade is not equal, but at the same time, this is how it works. So I get into a fight with this person, and at the end of the day, I just try to have them realize that the way consumers spend the way out of recession here in the U.S. is different than the way the government does it in China. Now, certainly there are crossovers here and there, but that's the difference between the two economies. And having China move from a government-based infusion of capital in order to grow to a consumer-based approach, which is what they do in the U.S., is antithetical to how they look at their mandate to be a country. They think there is still a great deal of Mao Zedong in the Chinese will to be a country, i.e., this is about, centralized governments, centralized approaches. We don't do that here. It's everybody for themselves, and at the end, we add it up, and, we usually do pretty well. Anyway, this is Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Each and every week we come to you through KCAA, our affiliate radio partner out in the Inland Empire. We're certainly on a number of different podcasts. TheMortgageVoice.com, that's our particular website. If you go there, you can find not only the guests on the show, but me, and find different ways that you can get in touch with anybody you want. YouTube is my preferred way because everyone goes to YouTube. I've seen more cat videos this year than I've seen in a long, long time. And so if you're interested in me as the cat video mortgage guy, Jeff Barton, the Mortgage Voice, that's how you do it. Go there, click that you like it. We always enjoy more and more people, although phantom people that come, you can stay home. I'm kind of sick of those people too. Anyway, mortgages. Oh boy, as I said, 8% dong. We heard the bell chime earlier this week, and we wanted to go to some great people and have them actually tell us what is happening not only at their company, but what's happening around the mortgage industry so that we can get a better handle on where we're heading and if 8% might be the low rate by the end of the year. Chris Calderon from Forward Lending. Chris, how are you?
Hey, good afternoon. How you doing, sir?
I'm great. Thank you very much. Well, you heard that silly introduction. I'm sorry about that, but
no, I'm a cat guy. I'm a cat guy myself.
Okay, excellent. All right, excellent. So, what are you doing in Forward? How are you bringing this percentage rate to the public? What kind of products you're offering? These are the kind of things I think that they're interested in hearing about.
Well, what we're kind of seeing right now is because rates have gone up and home prices have stayed pretty steady. We really haven't seen any kind of consistent drop. What we're seeing a lot of is borrowers having to qualify, and I'm not talking about a husband and wife, but I'm talking about borrowers that have to bring on their brother, their uncle, a friend, you name it, an enemy, whatever it takes to qualify. So what we're seeing is a lot more of the loans that we're seeing these days are requiring more people to meet qualification.
Okay.
Conversely, though, we are seeing a lot of non-QM stuff, where there's more of an alternative way to finance beyond tax returns, et cetera.
Okay, let's take up the first one. So you're saying it doesn't have to be a family member; it can be a friend, and how does that work in terms of liabilities and credit scores and amount down? Give us an example of what you're talking about.
Well, so let's say, for instance, let's say you were going to buy a house, and
Okay.
I haven't seen you, Jeff, at any of my family, parties. So I'm going to assume we're not family, but we are friends. We've known each other a while. So
Yep.
if you hit me up and you're like, hey, Chris, I'm looking to purchase this home, or I need to do a refinance, right? And I don't qualify. My income isn't enough because the interest rate's too high and the payment, right, et cetera, right?
Mm-hmm.
I would go ahead and be a co-signer, and depending on the loan program, will dictate what kind of FICO I need, and I have to income qualify, but my income will help you qualify. Now, hopefully, I'm not carrying too much debt where it kind of makes it null and void, if you will.
Mm-hmm.
But hopefully, I can help out and qualify that way.
Does this slow down? It sounds like it would slow down the actual underwriting process a lot. And does that affect purchase deals? And so, therefore, you need more time, or is it all done within the 30 days, like most realtors like?
It's normally done within the 30 days, like most realtors like. Does it add a layer of complexity to the file? Anytime you're adding an additional borrower, it's just like you go to the drive-thru. If you're just ordering a burger, fries for yourself, it's pretty easy. But if you're doing it for your buddy and a coworker, and you got to remember the whole order, it could be a little more complex.
That's
So
interesting.
it does add a layer of challenges, but nothing that's like detrimental. The file's going to be underwritten just the same. It might take maybe an extra half hour to an hour to underwrite it and review conditions, et cetera. So as long as everybody's credit worthy and everybody turns their loan conditions in on time, it doesn't really have any effect that way, no.
Are you seeing more conventional type loans? Now, we'll get into the non-QM in a second, or FHA type loans?
I definitely say with rates going up, we're seeing more FHA loans.
Mm-hmm.
So although there is mortgage insurance, I think borrowers just like seeing that lower rate.
Sure.
And with the fact that, the pricing's a little bit better, it might, depending again on the FICO, the loan amount, et cetera, might yield for the borrower to get some credit back that goes towards third-party closing costs.
Oh, that's a great point. I had talked a little bit about it, about certainly the less down, but I had forgotten, of course, that you might get a credit from the seller or in some way from the lender in order to buy down some of those closing costs. That's a great point.
Correct.
Yeah. So let's talk some about the non-QM space and what you all are seeing in terms of products people are gravitating towards in this market.
So what I'm seeing a lot of right now is I'm seeing a lot of people who are buying properties, investment properties, or refinancing properties that are investment. They're going with non-QM products, whether it be bank statements or full doc, with taxes, or a DSCR. But mainly you're seeing some of those borrowers turn to non-QM, and the reason is the rate might be higher, right, than a conventional loan, but it might come at no cost. Where, for instance, you might have a loan, for example, conventional 7.875, and let's just say it's a non-owner 3 to 4 unit, and you might get that 7.875, but it might be at a 2-point cost. So you figure if that loan amount, again, for instance, is $700,000, that's $14,000.
Right.
Or you can go non-QM, and maybe you're going to get a higher rate at 8.5, but it might be at no cost to get that rate. So
right.
For some borrowers, are just kind of weighing it out and just like, well, I'd rather take the higher rate, and when rates drop, I'll turn around and refi, but I'm keeping that $14,000 in my pocket. So we are seeing more of that. We're seeing a lot more DSCR, and then we are seeing a lot more borrowers who are self-employed take the route of going non-QM because they didn't claim enough income and using their bank statements as an alternative.
Is the bank or is the lender worried about a recession upcoming, or are they confident like some of the people, Moynihan or Diamond or these people who are saying no, it looks okay?
Well, I read an interesting article from Jamie Dimon, I want to say over the weekend, and he's a little pessimistic.
Yeah, I saw that too. Yeah.
Yeah, there's some. I guess the best way to put it, it's just a one day at a time approach, right?
Yeah.
Obviously we're heading into the holidays, which is always, a little bit more of a quiet time of the year.
Yep.
People are caught up with Christmas shopping, turkey shopping, Halloween, etc. But no, we're not seeing that. I think lenders now have come to the realization that this is what the projections are going to be, and I think they're okay with that. Mass layoffs, et cetera, that some lenders have done. That was done their last year or the early part of this year. I think everybody's kind of geared up and accepted the path and good to go. And realistically, I think we're really back to more of a normal market.
Oh, that's interesting. Yeah.
Right. Whereas the past several years, we saw a market that was abnormal with, interest rates so low that we're never going to see again. And so there was this frenzy. But if you really look at some of the data from 2019 and you take out 2021 and 22, maybe the first half of 22, and let's just say you went from 19 to 2023, it's not that far off. It's still slower. It's just not that frenzy that we've been accustomed to for the past couple of years.
Yeah, pushing the rates low and how we've hooked into the 10-year in order to look at that, we thought because of what's happening in the Middle East, we'd see a flight and a lot of money entering the U.S. Treasury market. Didn't happen that way, so the mortgage rates actually went up. It's usually quite the opposite. It's a very strange occurrence. I was thinking we were going to see a dip in mortgage rates by 0.5 point. We didn't. We saw them go up.
Right. We did see that one day where there was a bit of a reprieve, and then it just came back with a flurry the following days, the ensuing days. I really think right now, I think rates are going to be this way for a while. I think they might go up even a little bit more. But I do think, again, not getting political, I would never want to do that. But I do think in November of 24, once we figure out who's going to be in the White House, who's going to be controlling the House and the Senate, I think from there is when we might get a good gauge and see things kind of start to go down, again, depending on the party.
Yeah, I tend to agree with that. And obviously, we'll see what's happening with the economy,
Sure.
what's happening in the Chinese economy, these wars, blah, blah, blah. There's a lot going on, obviously. But there always seems to be something going on that affects mortgage rates. I just think the banks themselves have taken this and said, hey, you know what? There's way more risk today than there was 18 months ago. There's no more government backing, no more buying treasuries, no more buying bonds. They're actually rolling the bonds off, which is taking money out of the system, increasing risk. So all of this is,
Agreed.
Yeah.
So I think with that being said, and some things that we've, had to remind some of our customers or our brokers, and they relay the information over to the prospective buyers or borrowers, if you will, right, is there really never is a perfect time. There's never going to be a time in the economy where everything is stable and everything's, it just doesn't happen. If it's not the Middle East, it's the Chinese economy. If it's not the Chinese economy, it's Ukraine. If it's not Ukraine, et cetera, et cetera. There never is a perfect time. If there's no perfect time to get married, you're never going to be 100% ready. You're never going to be 100% ready to buy a house. There's never a perfect time.
Yep.
It's just like you said, it's the individual. What's the perfect time for you, sir, or you, ma'am?
Yeah, I agree. Chris, thanks for coming on. You want to shout out a way by which people can get a hold of you, especially on some of the excellent information you were giving on the programs that you offered?
Absolutely. The best number to reach me at is always area code 818-926-7078. Once again, 818-926-7078. If I don't pick up, shoot me a quick text message, and I'll circle back with you.
Chris, thank you very much for coming on the show. Always appreciate it.
You got it. Thanks, guys. Take care.
Thank you. That's Chris Calderon from Forward Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week as we come to you via the radio waves. And if you are listening to us through the YouTube, Jeff Barton, the Mortgage Voice on YouTube, our particular website, which is themortgagevoice.com, or any number of different podcasts, we really appreciate it. I know that there's one central podcasting area that if you haven't gone there, go there. It's our podclips.io. We're on there. It's a centralized way by which you can get a hold of any number of different podcasts, financial, health, certainly in the dispute resolution world. I don't know if you've ever had a contract dispute, but in the real estate world, happens all the time. How do you get to a resolution? Well, that's a show for you to listen to. And if you go to podclips.io, awesome. So I will join you there. Anyway, I'm Jeff Barton. This is The Mortgage Voice. We have brought back Nina Penny to the show once again from Malibu Funding. Really appreciate your coming on the show, Nina. And how are you?
I'm doing great. Happy to be here. Thanks for having me.
Thank you for coming on. World's ablaze, but there's always need for people who have equity in their homes to take advantage of that, especially if they're over a certain age. We've seen a lot of equity growth in homes, but because of the low interest rates, they've just had a difficult time accessing it. Give us a great way by which you can recommend, especially in the reverse world, a way by which accessing equity is not as hard as it might be otherwise.
Sure. Well, Jeff, there's an exciting new product out.
Okay.
And it's second. So let's say you have a lot of equity in your home and you have a first mortgage with a low interest rate. Most everybody now doesn't want to do a cash-out refinance on a conventional loan because you're going to go from your 2 or 3 to 8%. And nobody really wants to do that.
No.
So everyone's looking at HELOCs or, adjustable rate second mortgages or fixed rate second mortgages. Well, now there is a new product, a reverse mortgage second, and it goes up to $4 million.
Wow.
Here's the most beautiful thing about it, is that 55 or older, if you have equity in your home and a low first mortgage, and you would like some additional cash, you can take out a reverse mortgage second. Now, the most beautiful thing about it is that, number one, you don't have to make any payments on it. The interest will accrue in a kitty until the time you sell your home or the last person passes. They won't be going after the heirs if, for some reason, it can't be paid back. It's a non-recoursive loan. And the highlight of the product is that not only does it go up to $4 million, Jeff, but it also has an fixed rate of 9.9%, which is cheaper than most of the fixed rates out there.
Right.
Right now, fixed rates are probably going for 12, 13, 14%. And you can have this beautiful reverse mortgage that you don't have to make the payments on, and the interest rate is lower than most out there right now.
Well, this is a tremendous product. Are all the lenders who do reverse offering it?
No, there's only one lender right now doing it.
Okay.
And I'm very fortunate to have access to it and to provide it for the clients in California who might be interested in it.
No, it's excellent. An excellent way to present it because, like you said, most people, they don't want to touch a 3 or 4% mortgage. Why would you?
No.
There's a thing they call lock-in, right, whereby it's difficult to move, to access cash, or to, buy and sell, go up or come down on any property right now because the payments that you have at 3%, 4% are so low. This product allows access. Could you, do a little nuts and bolts for me. I'm in that age range. I have equity in my house. I have a 3% mortgage. What do you need from me in order to get started on this second?
Well, what we would need to do basically is to find out what the house is worth, your age, and the balance of the loan. Like I said, we go down to age of 55. Okay, so then we're going to come up with a number. Now, Jeff, the biggest thing is when we're in retirement, right?
Yep.
So taking on another loan is only going to decrease our monthly spending money, right? We're going to be taking on more debt. But with the reverse mortgage, you won't have to worry about paying it back.
Well, also, if you want, you can pay a little of it. You don't have to, not pay any of it, but if you did want to, you could pay some. This is the beauty of the reverse. You have choices each and every month of how you address the mortgage bill that comes. Either you don't pay it a little, pay interest only. There's all options, right, on the table?
You can do anything you want with it. So months, maybe you have some extra cash, you can put it in. But, in retirement, the only way to lower our monthly, to have more positive cash flow is by eliminating debt, or you go get a second job. Who wants to do that?
It's funny. There's an article I read about people who are in their 70s going back to work because, one, they're bored, and two, they need the cash. I mean, that's the reality of it. I mean, cost of living has gone up quite a bit in the last year and a half, 2 years, obvious reasons, but it's a reality. And for people on a fixed income, that's just not going to work. Tapping into the equity with this kind of second is really good. What are the FICO score requirements on this?
Well, the minimum FICO score is 600.
Okay.
If you have a 670 or better, you know what? It's a little bit of we require less documentation.
Mm-hmm.
And I think that, most people, in my time, most folks do have, relatively the minimum credit score needed. So that's pretty good.
No, it's excellent. Now, Nina, I don't know if anybody in the listening audience knows this, but you have such an experience, a wealth of knowledge, credentials in the reverse field for a long, long time. Helping people is really what you do in this. Have you seen the market change since since COVID or after COVID in terms of the desire, the affordability, anything that's happening with mortgages in the reverse world?
Well, during COVID, we had some of our best years, just like everybody else did.
Yep.
And up until the time when the interest rates started going up, it also affected reverse mortgages because, when interest rates are higher, it affects everything.
Mm-hmm.
And it affects the amount of money that the bank can give you in a reverse mortgage. So a lot of times people, may be short funds to get the reverse.
Mm-hmm.
And there is a reverse mortgage product out there that can also help people with that. Basically, I think for the first 10 years, you'll make probably about a half mortgage payment. So if your mortgage payment is $1,500, you'll probably make, a payment of $700 for 10 years. And then after that, it automatically flips into a reverse mortgage. That's one option for folks.
Well, that's a good option. That really is what you're doing is you're paying the down payment, right, over time.
Yeah.
Yeah.
Exactly. Yeah. So, we do have products. Of course, since the interest rates have been going up, it's been tough on everybody.
Uh-huh. How is your business, by the way? The only reason I ask is because in the conventional world, business is terrible, right? Everybody's been killed by the rising interest rates, and because the affordability, house prices haven't gone down. They've actually gone up in a lot of places, really making it difficult for anybody, let alone, first-time home buyers or single buyers to get into the marketplace. How's the reverse market doing?
Well, we're a little bit, we're definitely off too, right?
Okay.
Because the rates are higher, people aren't able to net a lot of money or as much as they were hoping for or want.
Mm-hmm.
So, people are really thinking twice about it. Also with the unstable markets, people are really afraid to do any kind of move right now.
Right. Right. No, I think that's true. I think when you're older and you're fixed income, you get very conservative. But I love this second product. We talk because accessing equity is really the name of the game right now. Everybody's property went up about 30-40%. So getting use of that money is really important. So standard seconds, standalone seconds, HELOCs, all that has really gotten a lot of play. But this reverse second really is something very interesting because it's a product that's cheaper and you can access the money. Now, is it the type of situation where you have a choice whether you access it right away or you have it, sitting there like a HELOC? How would that?
So this is just like this is the fixed rate. You get it all at the time of closing. So it's very comparable to if you get a HELOC, a fixed rate, second, right? But like we said before, those are going for between 11 and usually 15%. So here's one that has, as of right now, a little bit of a lower rate and a good payout for the borrowers. They get it at closing, and it's a closed-ended loan because it's fixed rate. They get it at closing, and then if they want to make payments on it, they can, but they have additional income, and they don't have to worry about adding another payment onto their monthly debt list.
Excellent. Nina, thanks very much for coming on. Great information. And obviously, like I said, I love this product. So if you could let people know how they can get in touch with you, either through your website or direct phone number, that'd be great.
My direct phone number is area code 480-635-2410. And my website is pretty simple. It's simplereversemortgage.net.
Nice. Okay, very good. I'll have to go there myself. I don't think I've seen it.
Okay, well, yeah, check it out, Jeff.
Thank you very much. That's Nina Penny from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. Nina, thanks very much for coming on.
Thanks, Jeff.
Okay, great. We'll see you next time. Bye.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us on each and every week that we come to you on Saturday and Sunday. You're driving around, you're back from some kind of religious thing, you're church, or you're out after the ball game on a Saturday, and you flip on the radio, and there we are. KCAA is the radio affiliate that brings us to you, and we are the kind of show where if you listen to it once, it might be helpful. But if you get into the habit of listening to us each and every weekend, or go to YouTube, Jeff Barton, the Mortgage Voice, you can get a sense and a feel of how the market is reacting to whatever's going on that week, that day, whether it's short-term interest rates, whether it's a war, whether it's, the availability of product that you need. That's what we're here for, and we really want to help you. It's always been the focus of the show, and the guests we bring on, yes, they are experts in the field, and this guy is no exception. Noah Shuffman comes to us from Plaza Mortgage. I've known him for a long time. Noah, how are you? How you doing?
I'm doing great, Jeff. Thank you for having me on again. It's always a pleasure to speak with you.
Thank you, and thank you very much. That's very kind words. Okay, so the mortgage rates. We hit that magic 8% this week. How is it affecting what you're doing over there, and what are some of the products you might be able to tell people about that you think might help?
Yeah, we hit the magic number, which I think everybody was extremely excited about. So,
yeah, I know.
yeah. Well, listen, look, I'm a big believer in you control what you can control and work within the parameters that you are given, right? And so,
Right.
listen, we're all, everyone focuses on rates, and really, I feel like what we should be concentrating on, is more payments.
Right.
Right? Payment driven instead of looking at rates. We've been, kind of conditioned to think about rates now, right? So looking at payment, looking at affordability, and one of my favorite sayings is marry the house and date the rate, right? If you can get into the house, which, listen, there's good news in this market right now. Yes, rates are higher and all of those things, but in many pockets, there's less competition. So if 2 years ago, a lot of people, good luck getting into a house because there was 10, 20, 30 or more offers depending on where you live and where you were targeting. And now there's not going to be as much competition, right? So if you qualify for a home right now, it's actually a really good time to get in, knowing that down the road, this is not your rate forever. If you can get in and you can qualify and you can afford it, then you can always improve your situation later on. So right now, I mean, there's a lot of great first-time home buyer options, things that we are looking at to help. I mean, look, at Plaza, we have a very wide product set, more so than any company I've ever worked at before. And as far as for first-time home buyers, we do all of the renovation products that are on the market right now. This is something that a lot of people aren't talking about. Renovation financing is a fantastic way for first-time home buyers to get into markets.
Is that like a 203K or something like that?
Yeah, there's a bunch of different products. So we actually are the only lender that carries every renovation product on the market. So we carry the Fannie products, the Freddie, the FHA, VA, and USDA renovation products. And what a great way to get into a home that maybe needs some TLC, right? You go in, you can finance the renovation cost of the property and build yourself instant equity in the home, which is an awesome opportunity for first-time home buyers, right? So that's something that a lot of people don't talk about. There's several different program options, and obviously we can discuss, individual, what product is better for what situations, right? There's down payment assistance programs. We actually just added a down payment assistance program for our FHA product yesterday. So this is brand new, hot off the press, but we're now doing an FHA loan with 100% financing, so 96.5% on the first, and then a small 3.5% second to get you to 100% financing. So that's very exciting, and there's various products out there that allow for down payment assistance. So we're doing those. Another great opportunity right now with the rate environment is buy downs, temporary buy downs.
Right.
And that's something that we offer. A lot of lenders are offering that now. And this is where if a home, especially if there's a seller concession, right? If a seller or a listing agent is having a hard time moving a property, it's oftentimes far more advantageous for them to market the fact that they're willing to give a seller credit, say 1%, 2%, 3%, versus dropping the price of the property. Because what does that do? One, it's going to help maintain, the property values in the area. Two, it's going to generate more interest because you can take that credit and apply it as a temporary buy down. What that means is you can take your current note rate and you can buy that rate down. If it's a 2-1 buy down, you buy it down 2% for the first year, 1% for the second year, and then you're back to your actual note rate the third year. You get far more bang for your buck by doing this. You reduce your payments drastically for those first 1 or 2 or 3 years, whatever temporary buy down you're choosing to go with. And then by the time that temporary buy down period is over, hopefully we're in a much more advantageous, rate environment, and you could then, refinance into a lower note rate moving forward. So there's a lot of great options for buyers and first-time home buyers right now out there.
I like all this, and I like Plaza because they're huge and they have a lot of offerings. And not to run down each and every one, but there are options, and having someone like yourself talk about just a few of them here today is an illustration. Some of the lenders have gone to niche products just because some aren't selling. You're offering all these products across the board. I like the DPA. I like the fact that you also have the buy downs. Those are good. Those became very popular in the last 6 months or so.
Yeah, maybe even going back a year. And I'll tell you, we also offer, which is fairly unique. It's hard to find, but we offer a 2-1 and a 1-0 buy down on one of our jumbo products as well, which is actually a pretty awesome offering.
How is the jumbo market doing? I heard that because there were so many jumbos out there at 3%, a lot of companies were shying away from them because they can't get rid of these or securitize them.
No, there's still a lot of jumbo. That in some cases that is true. Many lenders have pulled out of the jumbo market.
Like U.S. Bank being one of them that I've been reading.
Yeah, so on the wholesale side, several banks pulled out, but you're starting to see it come back. So,
okay.
And depending on the lender, of course, some lenders are, will be quicker back to market than others.
Mm-hmm.
And again, it's starting to come back. So you have a lot of those Alt-A or non-QM products out there, which we have a plethora of that too. I have great non-QM products, alternative documentation for borrowers, self-employed borrowers, or even real estate investors, using the DSCR product, the debt servicing the property versus using income to qualify. So there's a lot of those options out there. But on the A-paper jumbo, you're just now starting to see it kind of come back, which is exciting.
Yeah, of course.
So I have 4 jumbo products right now, and we have a 5th, a new jumbo product we're very excited about coming out in the next, I'll say 2 to 4 weeks. They're finishing all the legal and all that stuff with the investors. So it is starting to come back, which is exciting. What I'm surprised by so far is you're not seeing a lot of the ARMs come to play yet. Right?
Those ARM products got expensive about 2-3 years ago, and they've stayed expensive. I can't, I loved the ARM product initially because, for years it was so much cheaper. And if you're on the move or you're just an investor or you're, there are many reasons why you want a 5-1 ARM or a 3-1 ARM or a 7-1 ARM.
Well, I go back to the early 2000s, right? Before 2007, I think every loan I did was a 5-1 ARM at the time.
Right, so, of course, because they were going to refi anyway within the first couple of years, so why have a higher rate to begin with? Right.
Yeah, so, there's a lot of things that go into that, why it hasn't come back to market yet. But, stay tuned on that. We may start to see if we don't listen, this industry is cyclical, and we always seem to do this. We're always going to find a way to be, an alternative or to be creative and come up with a way to make housing more affordable, right? So if we continue to see the higher interest rates or an increase in interest rates and we're not seeing a decrease in values, investors are going to have to become creative and create easier ways for people to qualify. And the ARM is, in my opinion, is a way to do that. So, stay tuned on that. We'll see what happens.
Hey, we're up against it. Could you shout out a way by which people can get a hold of you at Plaza and get a hold of some of these products that you're offering?
Absolutely. So you can always go to our homepage, which is plazahomemortgage.com. You can contact me. My name is Noah Schuffman, and the email is noah.schuffman, that's SCHUFFMAN, at plazahomemortgage.com.
Excellent. Noah, thanks very much. Always love having you on. I haven't talked to you in a while, so it was nice to hear your voice.
Likewise, yes. Always happy to be on, and always good to connect with other people that understand the business and like to spread the good word. And by the way, I'm a big believer in positivity. Again, we can only control what we can control. We're all dealing with the same thing. And you know what? There's still great opportunity out there, and there's good home buying opportunity. You can get into a house now where, you've heard the stories. People put offers on 15 homes and can't get one accepted in the past couple of years. So
I agree.
There's good opportunity out there.
Noah, thank you very much for coming on the show. I appreciate it.
Absolutely. Thank you much.
Thank you very much. That's Noah Schuffman from Plaza Home Mortgage. Is it Plaza Home Mortgage or just Plaza Mortgage?
Plaza Home Mortgage.
That's what I thought. Okay, and this is Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week on KCAA, our radio station affiliate out in the Inland Empire of Southern California. Now, you can hear this show every Saturday and Sunday, and we come to you an hour each time to try to get you up to speed on what's happening in the mortgage market, what's happening in the real estate market, how this information might impact your decision making. And of course, we do that by first talking about some broad range of issues which would affect your psyche, a lot of people's psyche. I mentioned Facebook a little bit. I go on Facebook. I can't think about anything else if I'm in a Facebook argument, which is what I was. And I always tell myself, don't do it, and I always get sucked in. Okay, so if you're part and parcel like me, then you have to really just direct your energies towards what's the problem, why can't I get a house, how do I do that? And that's what the information on the show that we try to bring to you. But we do that through the guests we bring on the show. A lot of people who are account executives for different lenders around the country come on the show and pitch products. They say, hey, this is what we do, this is how we're doing it, this is the best that we can do. And in that, you can say, oh, that sounds like interesting. Go to the website, look up their name, or take it down from the show when they give out their personal information in order for you to contact them. You can do so and then therefore get more educated or more education about what's going on in the mortgage market program-wise. So these two approaches have been the way that we've have been doing the show for a long, long time. Okay, so just quickly, as I mentioned briefly in our earlier segment, yes, there is a terrible war going on in two different places, two different wars, and the victims of those wars are sometimes faceless, albeit as soon as it happens, we all get hyper excited by the view on the TV, and we all watch. And then after a while, especially here in the U.S., people forget. I just hope we can get to a place whereby, obviously, we have peace and we have stability and we have the best of us coming forward. I would like to say that's happening, but of course it is not. Yeah, and that's enough to say about that. In our own particular Congress, we're trying to get to a speaker or to somebody who can at least direct some of the opening of the government, maybe funding of the people who we call allies around the world, trying to help and stave off further and wider wars. Yes, this is what we're trying to do, and hopefully we can get some of that done ASAP. Again, I'm not picking sides. What I'm trying to do is to say if things are needed to be done, let's get them done and let's get serious people involved. It's not unlike the decisions you all make when you're trying to figure out whether you can afford the mortgage or not. Affording the mortgage is probably the biggest financial decision in any household, any family's life. I can put this much down, I can afford this much monthly. Is there a product out there that I can buy? And if there is, when and how fast, and all the intricacies of buying real estate. Anyway, I'm here. I'm Jeff Barton. You can always contact me at themortgagevoice.com. That's our website. And we are on a number of different podcasts as well. Darryl, do you have a list of those?
I sure do, Jeff. We're
Great.
on Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and themortgagevoice.com.
Okay, and in that, if you want to just make a comment, I'm all over social media, whether it's on YouTube, Facebook, whether it's X, formerly Twitter. I don't know why everyone says that, but it seems to be like you have to explain that, right? No, you don't have to explain it. And as a matter of fact, I just read yesterday that Elon Musk is planning to charge people to tweet. Here's a guy paid $44 billion for a company he now has to charge people to use. Unbelievable. Well, that just shows you that not even smart people know everything, right? I mean, he's going to take a write-off of 44B. Oh, boy. Can you imagine? Imagine if it was your house and you're making $50,000 a year and you came home and you said, hey, I've got good news and bad news. The bad news is, of course, we have to spend all our money paying down this bill. The good news is we have to spend all our money paying down this bill. So there is no upside to spending money, but with billionaires, who can know? So in regards to that, I have a list here, and I don't know, it's a little bit silly because I need a little silly in my life right now. Signs of low intelligence. This was put out by the Trump campaign. No, I'm just kidding. It's put out by Uncle Joe Biden, who can't remember exactly where the list was. Anyway, those two jokes aside, this signs of low intelligence I thought was pretty interesting, because we always are finding, especially as professionals in the real estate and the mortgage world, that there is a competitor, a silent person who is feeding the person we're trying to either educate or get into a committed loan or real estate deal, but feeding them information that either is wrong, not true, out of date, or just not helpful. It's either an uncle, a brother, a daughter, a wife, a mother, a friend, any one of these people is chirping in the ear the people we're trying to help get into a loan and a mortgage. Now, I'm not saying everybody in my industry is on the up and up, and a lot of people in the industry, yes, have to be watched. But when I talk to most professionals who've been around more than 10 to 15 years, they're interested in one thing and one thing only, and that's helping you do what you want to do by providing you not only with the best information, but with the best choices. So anyway, here are the top 5 reasons. What does it say? Signs of low intelligence. Not top 5 reasons, but the top 5 signs of low intelligence. Okay. Number 5, the main character syndrome. What does that mean? It means that when you're talking to these people who have low intelligence, according to this list, they make themselves the center of attention. Does this remind you of anybody? They always look at themselves as the answer, the problem fixer, the solver. And if you don't listen to them, you're the stupid person. You know people like that in your life? Stop listening. Number 4, pointing out when you use big words. Okay, so this is always one that intrigues me. I have a vocabulary, and I can't spell. That's a dichotomy. But you don't spell in speech, so I often look as if I'm using really big words. I said one, dichotomy. Anybody who's listening to the show who doesn't know what dichotomy is, it's okay. But if you see that you are being constantly corrected by people who say, oh, big word, or, ooh, you're using another big word over there, those kind of people you need to get rid of, because they're pointing out their own particular ignorance, not yours, or not your superior intellect in terms of pointing out that you think you're an elite. What you're doing is using the gift you were given, called a brain, in the best way you know how. If you're well-read, well-educated, even if you're not, using words that people who say, or you're using big words, get away from them. Number 3, no curiosity. People who just take the blanket, like, for instance, in the political world, some side or the other side saying the constant talking points over and over and over again. If I hear one more person talk about Hillary Clinton and the lost emails, oh my gosh, this is because people who have no curiosity as to why, to what's happening. It's the same on both sides of the political aisle. It's the same when you're talking about anything financial. People who don't know or have no curiosity to find out, you got to get the heck away from them. Full of opinions, but no facts. Number 2, believing everything they find on social media. You know these people. There are plenty of the QAnon folks out there. There are plenty of the MSNBCers out there. Those people that only look to the internet for their information but have no desire beyond that to find information above and beyond that. My wife last night was so sick of it, she said, I want to be able to just talk to who I want to talk to. Not talk to, who I want to listen to. So she turned on NBC News. Now, Lester Holt, I don't know if you know this guy, he's pretty straightforward, straight down the middle, that type of news reporting. So half hour, you're done. Like when it was, news was a half hour, not 24 hours a day. And number 1, being overly confident. We all know this person. I know, listen to me. You know the type. They're always pontificating, another big word, always pontificating about what they know and how they know it and where you should be making your decisions and what you should be talking about, and this is the way it is. We all know that person. In the financial world, nobody knows that person. What we know is that the world is changing, and what we're trying to do is present options in the best light today. That's how financial decisions are made in this particular market. because we can't guarantee everything. But if you find somebody that is and chirping in your ear, shut them off. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening to me, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Missed something today, yesterday, last week? Check out our podcasts at www.kcaaradio.com. We leave no listener behind.
It's that time of year again. No, not the holidays. Medicare open enrollment. And if you have questions about Medicare, you should talk to the local experts. Paul Berich and Associates. Paul and his agents are certified with plans that are accepted by most of the medical groups in our area. Call 909-793-0385. Their service is free, and after 42 years in the business, they're